Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital, and we are broadcast every week on Radio Northern Beaches here locally in Sydney and around Australia on the Community Radio Network. And this week, I'm really pleased to have at the microphone Joe Christie from Capital Property Funds. And Joe, thank you. This is your first time on the show. Welcome.
G'day, Ray. Thanks for having me. Nice to see you.
Wonderful. And ladies and gents, I did one of those things that I really hate doing. We forgot to press the record button first up. So we've had half a show worth of practice, but this is good because we know exactly what we're going to say this time around. Joe, can you tell the listeners a little bit about what Capital Property Funds does and your size and the kind of you invest your clients' monies in?
Look, thank you, Ray. Look, Capital Property Funds has been around for about 10 years. I'd refer to us as a mid-sized real estate fund manager. And where we invest our clients' funds, we two sides of our business. We buy commercial buildings, primarily office buildings, believe it or not. And then the other side of our business, we're a non-bank lender. So we lend money primarily to developers, mainly residential developments developers that are providing residential housing stock. We also do a little bit on childcare and industrial. So there's two arms to our business. The commercial office buildings, they're generally a longer term investment, sort of 3 to 5 years, and the lending is generally a shorter term investment, around about 12 months.
Okay, and roughly what size would each of these divisions be?
Look, they're about the same size. Like last year in our debt book, we wrote about $100 million in debt, which sounds like a lot, but we're as I said, mid-sized player, and we've got about $250 million of non-bank debt, and we're about the same size on the property side as well. So we typically we're buying buildings between $30 to $50 million for that fund.
Wonderful. Now, with that regard, one of the reasons, ladies and gents, I asked Joe to come on the show is that we actually met each other about sort of 3-4 weeks ago on some business dealings. And I found an absolutely excellent blog that Joe had written last year about something called the capital stack. And that's the reason I asked Joe to come on, not necessarily to talk about capital property funds per se, but it's good for you to have some background, ladies and gents, that Joe is licensed. He understands very, very well, this space in the property area and also lending against property and what, various parts of money lending in a capital stack actually relates to and returns. So that's the reason I asked Joe on the show. So Joe, maybe you might give the listeners and viewers a little bit of an overview of what the capital stack means to you.
Thank you, Ray. Look, it's quite close to my heart, and at Capital Property Fund, we're very focused on what we call risk-adjusted returns. So we're big believers in transparency, so investors should clearly be able to understand what they're investing in. And secondly, coming about that risk-adjusted returns, they're getting an appropriate return for the risk they're taking in any investment. So, and this all stems from what we refer to as the capital stack. And I'll use an analogy, if I may, where if you own your own home or you have a house that's worth, say, $100, I think most of us would have had a first mortgage from the bank to purchase that house. And I want to come back to why it's called a first mortgage. But let's pretend that we bought the house for $100 and we had a first mortgage at $60. We then might have needed a little bit more money to purchase that house. So we might have taken a second mortgage to get us up to $70. So the first mortgagor has provided $60, and then there's a second mortgage of another $10 that's got us up to $70. And then we would have put in our own money, that $30 to get it up to $100, and that is what we call equity, or it's also another way of saying ownership. Mm. And that's the capital stack. I mean, you can talk about, we just keep it simple that, first mortgage, second mortgage and equity. There are other terms like preferred equity, etc., but I think they're not relevant for this discussion.
Yeah, but things like mezzanine funding I've seen, and I guess sometimes there's a lot of jargon out there. And so thank you for the simplicity. Keeping it simple, first, second and equity, and we'll leave it at that. Yeah.
Yeah. I mean, that's great. I mean, given that you've mentioned mezzanine, like sometimes a first mortgage is also referred to as senior debt, and sometimes a second mortgage is referred to as junior debt or mezzanine debt. But basically, it's all just first and second. And what happens is, you can see in that capital stack is that at the moment, if you were investing in that capital stack, and I'm going to use an analogy of a block of land on the northern beaches, where that piece of property was some land that was going to be divided up into smaller residential lots. The first mortgage investor should be getting around about a 10% return. The second mortgage investor should be getting between a 15 to 80% return, and the owner or the equity holder should be getting between a 25 to 30% return. And the reason for that is that if the property falls in value, let's say it falls from $100 down to, say, $65, the first person to be repaid when that property has to be sold is the first mortgage holder. Now, any funds that are left after the first mortgage holder has been repaid in full are then used to pay the second mortgage holder. Now, that any funds left after the second mortgage holder has been repaid in full are then going to be left over for the equity holder or the owner. Now, in this example, where the property's fallen from $100 down to $65, the first mortgage holder is going to be fully repaid. The second mortgage holder is going to get half their capital back, and the equity holder is going to get nothing back. So obviously the first mortgage holder has taken the least amount of risk, therefore they get the least amount of return. The second mortgage holder has taken more risk, so they get a high return, and so on. So that's what we mean by the capital stack. It's very important to know where you sit in the capital stack and just making sure that you get an adequate return for the risk that you're taking.
I guess it's one of those fascinating things that many people that certainly you and I talk to aren't, and I say this with the greatest of respect, aren't old enough to have necessarily seen large property value swings. All they've ever seen is up, and more up. And I guess one of the fascinating things that when we talk about degradation of value, probably the only market that here in Australia that we've seen that kind of tumult would be Western Australia, for example, where because of the mining boom and bust, a lot of their property had quite a lot of variation, 30, 40 odd % in valuations. Whereas, when we look at Sydney, Melbourne, Canberra, for example, it's never a case of down, and it's maybe tapered a little bit, but what we've seen is really going up. And so people look at this kind of investing and never really think of the downside. But, both you and I have lived through downsides, haven't you?
Absolutely. And look, it's such an interesting discussion, Ray, that you mentioned, not picking on Western Australia, but you'll also find too that the further you get away from metropolitan centres, you get a bigger vacillation in prices too. Is that those more regional distant centres also tend to fluctuate. They're the first to get hit in the downturn, and they do move. Yeah, look, I agree with you. I think Sydney, Melbourne, Brisbane, Adelaide, Perth. Actually, I can't. Perth might have a bit of movement, but Canberra, they've all, property remains pretty solid there. And as you said, it may taper, but generally remains pretty solid.
And one of the things, ladies and gents, that Joe and I guess, had this wonderful mind meld. I refer to a series of e-booklets that I wrote a number of years back, trying to explain what a bond was. And I guess certainly what we do in the private debt lending, these are commercial bonds. And so I was trying to explain to people, and in my very first booklet, ladies and gents, I refer to a mortgage. It's actually a French word. Mortgage is engagé à mort, which is engaged until death. And so when I read this, and again, coming from an Italian background, I should have seen it, because morto and more, they're Latin-based words, but engagé à mort, that we are looking at being engaged to these things for life. And Joe, again, when I go and visit my cousins in Italy, they have mortgages that have been passed down to them by their parents and grandparents, because property is, particularly in Italy, a lot of people don't necessarily own property. We are, in Australia, a population that has a love affair with property, but we're also amongst the highest owners of private property around the globe. And so I think we get lulled, though, and one of the reasons I wanted you to come on the show to talk about the capital stack is to talk about risk and talk about that when you bank that up against a mortgage. And so you've talked about a first and second mortgage. I guess it's not too different, for example, when we read about companies that go into administration, an administrator will come in. It's a similar kind of thing. There are people that are first in line, second in line, and people right down the bottom. we're talking no differently when there's a for sale for a house or a piece of land where a mortgage is involved. Is that not the case?
Absolutely. I mean, I think in parlance for administrators, they call it the waterfall payments. Is it who gets, as they wind up a business, there's a water flow or a cascade of who gets paid first, second, third, and so on. And it's very, very similar with property, and we use a term internally here. And I think it's a relatively common industry parlance is the capital stack. Yeah, but first mortgage holders get paid first, second mortgage holders get paid second. And I always say after the first mortgage holder has been repaid in full, the second mortgage holder gets paid second, and then equity holders get paid last, and that's after first and second mortgage holders have been repaid in full. And so it's a very common way of doing winding up an asset.
And I might highlight to the listening audience too, if it's a business being wound up, there's somebody that gets paid first before the first and second mortgagee, I might add. It's called the tax office. Okay.
Yes.
The Australian tax office is absolutely and always the first to be paid. And the poor old workers and their super end up being last because they're definitely equity people and poor old shareholders that are way, way down the bottom of the list. So this is all good stuff because, ladies and gentlemen, we're just about at our halftime break here on Dollars and Making Sense. And when we come back, Joe, I want to talk a little bit about some terminology, including LVR and again, some other things around the capital stack. You're here on Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. We're going to take a short break and we'll be back in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson, and at the microphone this week we have Joe Christie from Capital Property Funds. Now, before we went to the break, Joe, we were talking about being engaged until death with these mortgages. And it's the kind of thing that, here in Australia, we have this love affair with real estate. And I guess the thing that often concerns me is that everybody seems to attach safety and guarantees to real estate. And I guess I'm a bit of a Debbie Downer. I'm here to say to people, look, there's risk in investing in anything, including bank bonds and Combank and the big four fixed income type stuff. There's always risk. But one of the things that I wanted to bring you onto the show, and when we're talking about the capital stack, and you use this great term before we went to the break about risk adjusted returns, and this is the thing that I think a lot of investors sometimes forget. They start looking at wonderful numbers and then they don't see the kind of real risk that's being associated with it. So I wanted to introduce a little bit of terminology into the second half of the show. And first and foremost, if you can explain to the listeners what LVR means when they're thinking about real estate. What does LVR mean?
It's a very good question, Ray. Look, it's loan to valuation ratio. So for example, if we look at that example I spoke about earlier, is that the property that's worth $100, what you should have is an independent valuation from a certified and qualified valuer that says this property is worth $100, and if you're lending,
and just very quickly, that may not necessarily be a real estate agent, ladies and gentlemen. Real estate agents know values, but that does not necessarily make them a qualified valuer. I think it's really important to note that too. So remember what they're trying to do. They're trying to get your listing. So they may say things that aren't necessarily the truth and the whole truth. Sorry, please, Joe, please continue.
No, you're right. And look, most of the stuff that I'm dealing with too, and it's such a good point that you make, Ray, is that we're because we're paying, because what you're getting at these 10% returns, which seem quite high, is that you're generally you're dealing in risky assets, what we call development assets, or primarily residential development assets. So there's a few moving parts, and they are more complicated to value. So you do need to have a suitably qualified independent valuer who specialises in that market. They do a discounted cash flow analysis. They'll do a comparable sales analysis, all sorts of stuff. And you generally, it's a $20,000 to $30,000 report that would be commissioned by the promoter of the scheme, and it should be independent. And generally they're 50 to 100 pages in length. They're very detailed documents. But valuation, so loan to valuation ratio. So if the asset has been independently valued at $100, and you're lending $60 against that $100, the LVR, the loan to valuation ratio, is 60%, and that's LVR. That would be the first, and then if someone took out a second and they were lending another $10, then the second mortgage would have an LVR, loan to valuation ratio, of 70%.
So I guess from that perspective, percent is per 100. We try and keep the numbers as simple as possible. And the one thing that people need to be, again, aware of is that in the commercial lending space, these are usually non-bank lenders. So we're not talking now about consumer coded loans, because I've had this. People have rung me up on my 1300 number going, yeah, but Ray, I can go to the bank and get this kind of rate. And I'm saying, yes, you can. And you can get up to 80% LVR with your documentation when you go to the bank. But that requires you to be able to show something called serviceability. And again, that's where I'm always trying to educate people that when they're investing in commercial loans, we're talking about a different kind of borrower to the borrower that turns up to the high street bank and says, here's my pay slip, here's my letter from my employer, and they're borrowing, for example, up to 80% for 30 years. That's not what you do, Joe, is it, when you're talking about private lending over 12 months? Maybe give a little bit of a background on how that kind of lending works within your framework.
Ray, you've asked so many good questions here. Yes, look, we're lending to integrated, high-quality developers who are very good at what they do, and believe it or not, they actually make more money borrowing from us at 10% than going to the high street bank at 6 or 7%. And people say, well, explain, how does that work? And that if I'm a developer and I'm going to develop 30 blocks of land, and let's say the blocks of land are worth $1 million each, that means I'm going to net $30 million once the development is completed. And generally that would take around a 12-month period. So if they come to Capital Property Funds on 1 January, we fire the starter's gun, we lend them the money, and then generally by in 12 months' time, 31 December, they're netting $30 million, or they're grossing $30 million. Sorry, then they've got to pay our interest fees, which are significantly higher than the bank's, a couple of $100,000 more. If they go to the bank would require them to pre-sell those blocks of land. So instead of selling 30 blocks for $1 million each, they would sell them for, say, $800,000 each. So there's about a $6 million less income that they will get, and it'll take them sort of 6 to 9 months to get those sales. So it might take them 18 months to complete the project, and they'll net $6 million less, but they'll save a bit of money in interest. So really good quality, smart, integrated developers are using non-bank lenders. I prefer to use the term non-bank lender or real estate debt as opposed to private debt. I think that private debt is generally lending against a business, whereas with real estate debt or non-bank lending into real estate, we're lending against a hard asset. There are some subtle differences, which are something we could chat about at another time.
Sure, Joe, you make a very valid point, and I guess I use that terminology loosely because I've seen it interchanged.
Absolutely, it is interchanged within the industry quite a lot, because I talk to financial planners who invest in private debt, and then they'll be getting the same, and I have to, if you really break it down, there are completely different risk-adjusted returns between private debt and real estate debt. I actually for what it's worth, I think you get a much better risk-adjusted return for real estate debt than private debt currently.
I couldn't agree more. And given the fact that my own fund does this kind of lending, it's something that we see on a daily basis. But on Dollars and Making Sense, what we're about is, I guess, financial education. And one of the things that I really wanted you on the show is to really prompt people to start looking a little bit more critically at when they're looking at property-related investments, and whether it's a person that lends money or whether they're doing a development. I mean, I have seen some returns in the marketplace for people that are out there saying, hey, we're going to go and build a bunch of homes, or we're going to grab an old farming plot and turn it into 30 or 50 blocks in a subdivision. And after all is said and done, even in these days, they're coming back and saying, hey, and we're going to give you 8s and 9s for that. And I'm sitting there going, wow. I mean, that to me is gobsmacking, not for the reason that the investment's going to be poor quality. I think the investment will be great. But if I was giving a development agency money at 8 or 9%, and I'm tied to the success of that project, I'd want a heck of a lot more than 8 or 9%. And that's all they're offering. But people look at it and they fall in love with real estate. And this is why I wanted you to come on the show. And ladies and gents, we're going to link Joe's blog on my blog, and I'll also put some links to Joe's website. But this blog is all about when debt is fooling people into thinking that they've got this great investment. But at the end of the day, you end up taking all the risk, and the developers getting very good money and cheap money for not a lot, I think, in return. Would you agree with that statement, Joe?
Ray, look, I can't agree more. I mean, there's nothing wrong with taking on risk, but as long as you're getting adequately compensated for it. And we use the term equity parading as debt. Is that I'll often see people saying, I'm getting a 10, 11, 12% return. So that's fantastic. And then you look under the bonnet and you can see, but hang on, there's a first mortgage holder here. You're sitting in a second position. Oh, am I? And I go, yeah. And then a high component of your return depends upon the commercial the commercial outcome of the project. I said, this is starting to look like equity. You should be getting a 30% return. What are you getting paid? 10, 11, 12. I said, well, yeah, that's not very good, and, really have a look at, and yeah, it's hard. I mean, there's so much to talk about there, Ray, but I really emphasize nothing wrong with taking the risk, but make sure you're getting the appropriate return.
And I guess that's my point of being educated. One of the things I keep on saying to people, please read your documentation that you're given by the investment company. And I don't know whether it's our age group and they're getting on and going, oh, I can't be bothered to read. It's like, well, if you can't be bothered to read, don't start whinging when they take you to the cleaners, because some of the IMs and PDSs that I've read, it's staring you in the face. And what they're saying is, hey, we're not going to give you a huge return, even though you're taking all the risk, because and this is, again, the love affair we have with real estate. We haven't seen enough in our cycles where people lose money on real estate. I mean, in America, when the big GFC happened, their real estate prices dropped by 50, 70, 80%. And when you've got that kind of carnage, if you're not in that debt stack in the right place, you're going to lose the lot. But the problem is we haven't seen that here. And so when the market valuations keep going up and up and up and up, people don't bother reading. And I'm not suggesting the market's going to implode tomorrow. I don't think it will. I'm just simply saying to people, please read your documents and be a little bit more discerning about what is investment in debt and what is investment in equity.
It's such a good point. I mean, I think you're right. I don't think property is going to collapse, but where you can have, degradations in value is in these development projects, where you're taking on a risky project. You're building some blocks of land or apartments or something like that. There's cost blowouts with the builder. There's rain delays, or they strike rock as they're trying to get into the ground, and the project has cost overruns and delays and whatever. That's when you can lose money. And generally, and this is an awful thing to say, but generally people that if they're not being transparent in their promotion, as in they're not clearly stating whether you're a first, second, or an equity holder, and they're not paying you a commensurate return for that risk that you're taking, they may not be as competent as being developers either. Generally. But saying that, very good, competent developers that are honest, straight, ethical, can still get into trouble, and nothing's risk-free. But yeah, I'm a big believer in openness, transparency, and as I said earlier, getting a risk-adjusted return.
Okay, so here on Dollars and Making Sense, I'm always about some freebie and giveaways. So on our website, we're going to have the links to our respective websites, but I'm also going to link Joe's blog, The Capital Stack, equity parading as debt. And so I think, it's a really good article. It's barely a 2-minute read, ladies and gents. It won't kill you to sit there and read it. I think it's a great read. Doesn't matter that it comes from Capital Property or wherever. Joe, I think you've done the public a great service by writing that blog, and that's why I wanted you to come on the show. We're out of time today. Joe, thank you so kindly for coming on Dollars and Making Sense. Love to have you back again. And until next time, thanks for joining us.
Ray, it has been an absolute pleasure. All the best.